Welcome to Debating Your Dollars, where two financial advisors have two opinions with one goal in mind, to help you make sound financial decisions around your dollars and how they can work for you. So on this episode of Debating Dollars, we're going to talk about a topic that Niko and I go back and forth in our planning sessions on, some things we talk with clients about. We're going to talk about a Roth IRA conversion. Before we get into that, Niko, can you explain what a Roth IRA conversion is to our watchers?
Sure. So in simple terms, your Roth conversion would be moving money from either a traditional IRA, 401k, 403b, or probably the three most common accounts it happens to, moving money from that account over to a Roth IRA directly. Now, there's tax consequences to that because you're moving it from an account that hasn't been taxed yet to an account that grows tax-free.
Right.
So you pay ordinary income tax on a portion of the conversion, and then it grows in your Roth tax-free forever.
Right.
Now, there's different rules and penalties and stuff like that we'd have to dive in deeper. So don't do this without consulting a professional first.
Right.
But that's, in the simplest terms, that's what a Roth conversion is. It's not, you're not contributing or like putting money from your wallet into a Roth IRA. You are moving it from either a 401k, 403b, or traditional IRA over into a Roth IRA.
Right. And it that transition is taxable. There's a taxable event that occurs there, and Niko hit the nail on the head. Make sure that you are consulting with a tax advisor, tax preparer, whenever you're making this decision, because as we're going to discuss now, the taxes are typically the reason to consider a Roth IRA conversion. And we look at them for our clients. We talk with our clients about them. But execution, we know, is a lot different because watching that tax get paid, I think, is why a lot of people don't do this.
Sure.
You know, if you think about someone that's in the 30% tax, marginal tax area, and they want to do a Roth conversion, that's $30,000 out of every $100,000 that goes away.
Yeah.
And that, regardless of whether it makes sense to do or not, it can make all of the sense in the world. But watching that tax get paid sucks.
Oh, it takes...
That's the only way I can say it, is watching that tax go, leave your account, hit your balance sheet, change your value. That sucks. That hurts, and it's not a fun thing to witness.
It takes an incredible amount of an emotional stamina and intelligence.
I agree.
To do it, and I don't think that's why... I think it's why a lot of people don't do it. I don't think that's much of a debate there. But then if you look at like the biggest retiree pain points, I would say a lot of people that have saved up in their 401ks over the course of their lifetime, it's RMDs.
Sure.
And they go, this is crazy. I'm paying more in taxes. And we talk about this all the time. I am paying more in taxes now that I'm retired
than I ever did when I worked. Right.
Than I ever did when I worked.
Right.
And that's basically, it's like the financial frontier. People are just retiring with 401ks for the first time. Like pensions were dominated it before that. So they really are the financial frontier, and they're the first ones to have to deal with this issue.
That's fair. That's a really fair point, is, you know, they haven't watched these decisions come to fruition. And we talk about this all the time. Our profession has really transitioned over the last decade from this suitability standard to a fiduciary standard. And the fiduciary standard requires us to have conversations about what's in your best interest. Suitability just really meant, are you meeting your risk profile and are you meeting your income level?
Yeah.
And from there, yes, that investment was suitable. And now it's okay, but we also have to decide, is it going to put you in the best situation possible? And if it's not, we're obligated to have those conversations. Just like a doctor's obligated to have a conversation with you that says, we need to cut you open to fix you.
Yeah.
The last thing they ask you is, how do you feel about that?
Sure.
Well, none of us want to be cut open.
Yeah.
None of us want to be, but we also want to be healthy. So, you know, it's kind of the same with our money. This is kind of the best scenario to think about. And again, the decisions are too late.
Yeah.
Because now we're in the RMD phase, and we realize what that tax bill looks like on a big distribution that we don't necessarily need, a big distribution that is not going to our heirs, it's not going in our pockets, it's ending up, in Washington.
And it's kind of the education on tax planning out there is terrible because originally, and this isn't how it works now, originally accountants did tax prep and financial advisors did investments, and there was this giant gray space called tax planning, and no one did it. And now certain accountants are starting to get into it. Certain advisors are starting to get into it, and there's conflicts there. If you go on LinkedIn and look up our Roth conversion is good, someone's going to be saying no, and then someone's going to be saying yeah. If you go on Google, it's going to warn of all these penalties. I'm looking at it right now, and says the upfront cost against long-term gains. And you're going to get confused, and you're going to close your laptop.
Well, I want to ask you a question while you're discussing that. You just passed your CFP exam.
Sure.
You just did your Certified Financial Planning Education Training.
Yeah.
What was the dominant topic in all of that education?
Oh, tax planning. Yeah.
Right. It wasn't buy low, sell high.
Yeah.
It wasn't,
no.
Which asset class does well in certain markets. It was tax planning.
Yeah.
Because regardless of what the market is doing, and we know the market is going to move, and it's going to go up, it's going to go down. That's really the only certainty that we have.
Yeah.
Is that there is no certainty when it comes to the market, but there is certainty when it comes to taxes.
Yeah.
Unless you can get 535 folks in Washington to agree that there is no more taxes, there is going to be a certainty that taxes are a necessity.
I had a mentor for my CFP that really spelled it out for me in for the CFP exam, that really spelled it out for me on why the tax planning portion is becoming more and more important. A really good advisor is going to get you maybe 1 or 2% difference.
Right.
The savings on taxes is typically around 25%, wherever you fall in. So it's becoming more and more important because, if they had to choose between 1 or 2% over here or 20 over here, they're taking the 20 every time.
It's why it's so important for us to work with our advisors or our clients' advisors, whether it's their tax advisor, their insurance advisor, or ideally their wealth advisors. But it's so important because we all have an impact on their money.
Yeah.
We all have an impact on their legacy when it comes to their money. And we need to help them and do this tax planning and because I want to make sure we zero back to the Roth IRA conversion because the process. Talk a little bit about what the process is, and because that can be confusing, and we want to make sure that it's done correctly.
Yeah. So the first process with anyone is this is not a Swiss Army knife financial planning tool. This is a highly individualized financial planning tool. So the first process would be one, getting your tax return, right? Just seeing where we are immediately with last year's history.
Right.
Step two is we use our financial planning software. We analyze what's called the tax valley, and that's when, so say you're still working now, that's one peak on the tax valley, then you just stop work, it's a little bit lower, and then the next peak is when RMDs start.
Sure.
And that's difficult to talk about, but if you think about it, just think of it like a mountain range, basically.
Yeah. Two peaks in your income, and what happens in between is, quite frankly, where you get the most control over your tax situation, because that's when you can decide what your income looks like. One thing to preface before you go much deeper, it's very important to talk about these before you make a Social Security decision.
Yes. Yeah.
Because Social Security can push that valley up a little higher. So it's very important to understand what this strategy looks like before we tell Uncle Sam, hey, start sending me my Social Security checks.
Yeah. So for the average person that we're considering a Roth conversion strategy for, what their tax valley looks like is it looks like the Appalachian Mountains, where it's a little bit high. Then it goes down into a valley, and then it gets up into the Rockies, and then it never goes back down. Then it goes back up into the Swiss Alps. And the goal with tax planning and Roth conversions would be to plateau those taxes,
right?
To make sure that taxes are fairly consistent throughout the course of your lifetime, and then also not dumped on your beneficiaries in the end.
Right.
Trusts have different rules, and even if you have
Well, we could have a whole other discussion on what inheriting that IRA looks like, because, if it's impacting your tax situation, it's going to impact somebody's tax situation, whether it's your spouse, your children when they inherit this, or whomever.
Yeah.
That inheritance is not coming free.
Yeah.
And I think what ends up happening is folks say, I'd rather not watch that tax get paid, and I'll be in the ground, let them pay it, because, and I can't say it enough, watching that tax get paid stinks.
Yeah.
It feels like an investment loss. And we know how bad folks feel about investment losses.
Yeah.
And this one is one that they kind of decided to take. But now continue going through the process.
Yeah.
So we can understand
basically
why that loss isn't such a deterrent.
Basically, what we would do then from there to try to make that plateau, the tax plateau, instead of the tax mountain, would be you're going to find a number based on the current tax brackets to try to convert every year and keep it consistent. So we're not always doing a lump sum up front. Because if you do the lump sum, if you recommend lump sum, it's not getting done. Unless they have some major tax credit deductions that we work with them for, it's not happening. So we try to find a fairly consistent stream of income. So for some clients, I'm trying to pay taxes at the 12% income tax level every chance I get, because that's a very favorable rate. Sometimes it's, hey, we're going to pay 22 now, but we're going to pay 24 or even 32 later. So why don't we pay the 22 now? That's 10% difference from 32. So it's really finding that common ground and that common number. And then it's the best conversation to have with them January 1st and go, hey, if we experience a little bit of market volatility, we'll do it then so we can convert more for the same price. And then we'll let our portfolio recover and we'll continue to move on. And you actually paid less taxes just by converting in a dip.
Yeah.
So the ultimate goal is to transition it from looking at taxes in 1 year into looking into lifetime tax planning.
Yeah, I agree.
And then once we do the conversion, it's fairly simple administratively on our side. And then you have to file the Form 8606 with your accountant or tax preparer. So it's not a very difficult process. It's really just educating them on, okay, what's that bracket? Like, what should I
understanding
convert?
that bracket. And again, the software is very helpful. The planning processes and softwares are getting so much better that help us, dial into a zone as to and what we can do, and then being able to see what that impact is.
Yeah.
So, it may stink to watch that tax bill get paid this year. However, when you see the impact that has on lifetime taxes and saving of lifetime taxes, and ideally enhancing your net worth and enhancing the legacy to your heirs, it becomes well worth it to at the very least consider this.
Yeah.
But having, again, our mission with this segment is to make sure folks are making decisions with all of the information.
Yeah.
I guess, can you ever think of an instance where it wouldn't make sense to do a Roth conversion?
I would say taxes going down. Like that's the one factor you cannot control. But I think if you put people in a classroom and said, raise your hand if you think taxes are going down, you'd be lucky to get one.
Go up, right? Well, or if, and the reason why, you talked this bit there about market volatility and how that can sometimes make sense. However, the end of the year is the smartest time, because you have no idea what your year is going to look like. You have no idea, if you're going to get a bonus, a pay raise. Ideally, you're getting both of those. If you're in business for yourself, you have no idea if you're going to have a giant contract pay in that year. And if you do a Roth conversion in April and then your tax situation changes and you earn more money or end up in a higher tax bracket in October, it could have been a very expensive transition. If you're inheriting assets that you didn't know about, we don't all have that crystal ball that knows when we're going to start inheriting things and needing to do things. So making sure that it's on your radar in January. And if it's going to be something you execute, it stays on your radar throughout the year. And then later in the year, you're having those conversations about, okay, Now it makes sense so that we can do this transition as efficiently as possible.
Another issue with it too is you do have a 5-year clock on every conversion, right? That's why I typically don't recommend doing lump sums up front, because you don't really reap the rewards of the Roth, or at least getting the tax-free gains for 5 years off each conversion.
Right. So each conversion has to stay in the Roth for 5 years.
Yeah.
Before it's eligible at a tax-free distribution.
Yeah. So basically, anytime you pull from your Roth, it always goes contribution. So any money you put in from your pocket,
right,
you comes out first in terms of it, and then the conversion comes out next, and then gains. So you have a buffer, right? Like, you're not totally susceptible to that rule,
right?
But if you're just, if you're gonna spend, if your plan is you're gonna spend a lot of your qualified money first for whatever reason, then it may not even be worth it if you don't have the time horizon behind it.
I want to ask you one question that mostly to play devil's advocate.
Yeah.
Why do the conversion rather than just do the traditional IRA distribution? If that 5-year number is a problem,
yeah,
you make the assets illiquid again. Why not just keep the money?
They're not necessarily illiquid, but that's my point. If you don't have the time horizon behind the conversion, then a lot of times it doesn't make sense. That's the bear case per se, is like, if you don't have the time horizon behind it, why do the conversion? You're exactly right. You wouldn't. Yeah. That's why it's not a Swiss Army knife financial planning tool at all.
And I want to jump on that statement for a second. Very rarely are there any financial solutions that are a Swiss Army knife. Part of, in my opinion, our industry's troubled past was the steak dinner seminar.
Yeah.
That was everybody in this room who I'm buying a steak dinner from should buy this product.
Yeah.
Or should do this strategy. And it's helpful to learn about strategies, but rarely is there a strategy that makes sense for everyone to use. And that's something to consider here, that this is the same.
Yeah.
It's not a Swiss Army knife that solves for everybody.
I want to transition almost to two cases where it's not talked about enough of why you should use it.
Okay.
And I would say the widow penalty is the least talked about conversion reason. So basically what the widow penalty is say you and your spouse both have large 401ks and one spouse passes away. A year later, you're in a single tax bracket.
Right.
So basically what that means is, like, married filed jointly, the 12% tax bracket ends at 100K, or give or take a few $100 there. But in single, it's like 48,000.
Right.
So you're being double taxed for your spouse dying early, and this strategy is typically an end of age type strategy when you start retirement, and really in that tax value that's typically from like 55 to 70. There's a lot of people unfortunately pass away before 75. So if you both have large traditional IRAs, 401ks, whatever it is, and you pass away, you basically, it's like losing half your money to the government. Your tax bracket's double. You don't lose half your money, but your tax bracket's doubled.
Right.
So it's a little bit
Not
of
doubled. It's cut in half.
Or your tax brackets are cut in half. Your taxes paid double.
Can double, right?
Yeah. So that's the least common thing that's talked about. I think another scenario is, our government workers, or even, for example, in Pennsylvania, teachers, so let's think about it. You're getting a pension, a pretty favorable pension at first. And for most clients, I would say in our retirement distribution planning meetings, that pension's covering the bills for the foreseeable future, barring the major expenses like a roof or maybe a new car or something along those lines. And that same pension's probably going to keep you right around the 22% tax bracket anyways.
Right.
So my thought process always goes to, all right, what room do we have left? And at what point am I done growing the government's money for them in the traditional IRA?
Right.
And at what point am I going to start transitioning it over to the Roth slowly, so I have liquidity in the benefits of a Roth for expenses like the car or the roof or whatever happens along the way, and start just making it all my money. And then if I never use it because spending typically goes down after 75 or so, you're not traveling quite as much, my beneficiaries get it. That's a perfect example of clients that typically use it, is the one that goes, one, I have all this money. What do I do with it? I'm never going to spend it. It's going to have to go to my kids anyways. Or two, I have a pension that's covering the bills for the foreseeable future. What do I do with the lump sum?
Right.
So those are the two scenarios I would say it most commonly happens. And then also trust. So if you leave an IRA to a trust, you don't get the 10-year roll, the 10-year payout roll. You get a 5-year. So say it's $1 million. The trust has to recognize income of $200,000 a year, assuming no interest, to drain it. And trust tax brackets are a whole nother issue.
Right. It's a different tax game altogether.
Yeah. So without getting too far into that, you basically just tax at a high rate anyway. So it all goes back to the point that I'm 55. What do I do with this? And it typically, like I said, we do the analysis, see if it works. If it works, it works. If it doesn't, we let it go. And
at least let them make the conversation or the decision with all the information. And seeing what that impacts looks like.
Yeah. So I think like a lot of this, like if you look up guys, I think it's Ed Slott. It's read his book once, and it is fascinating to go back and see the marginal tax brackets. Like we're pretty much, if you look at it, we're not I don't think we're at an all-time low, but we're right around about as low as it's ever been.
Historically, a pretty good tax scenario.
Yeah, so
all things considered.
My case has always been like, I would like to use those brackets and keep as much money as I can in my clients' pockets than just watch it go away whenever they eventually pass.
Yeah.
Or when they're 95 and have to take a 15% RMD on $1 million. I have to recognize $150,000. At 95, you're probably not spending.
Right. That's a fair point.
So
consider these discussions, get the analysis done on what a Roth conversion looks like.
Sure.
Understand either the cadence at which you're doing the distributions.
Yeah.
Understand what that tax expense is, or if it saves you money over your lifetime taxes, and how to execute that. And again, making sure you're communicating with all of your advisors, especially your tax advisor, because filing this is it's important to do it right.
Yeah.
Because you want to make sure that the tax benefits follow you and you're not squandering them.
Absolutely. And mistakes cost money. So like I said, always use a professional for this. Understand the risk, understand the consequences, see if it makes sense for you. Don't Google this. It's going to make your brain hurt. I promise you that. So it's not going to give you a good or a bad answer if you Google it. It's just going to be like, well, it depends. And that's the famous go around is it depends.
It depends,
and then
right.
You close your laptop and ignore it forever.
That's it for this episode of Debating Your Dollars. If you have questions, please reach out to us on hoffmanwealth.com or schedule a call with our office in the show notes below.